My name is Greg Fleming. I'm the portfolio manager for the SALT Capital Growth Fund. And I am also the head of the global diversified funds for SALT Funds Management. That means I am basically a multi-sector strategist. Always have been that in my career, looking at both bonds, corporate and sovereign, equities, domestic and international currencies and alternatives. Well, the Capital Growth Fund is designed to grow investor capital over the medium to longer term. It's a fund that's been structured to be relatively stable from year to year and not to be too dependent on major trends in one part of all over asset allocation. So not overly reliant on one particular asset class, rather diversified across a wide range of asset classes for different market conditions. We see that the sectors in global infrastructure and global real estate, for example, which are typically not well represented in growth funds domestically, deserve a higher weighting than you'd typically find because of structural trend forces that are changing what is in demand around the world. Really an investor who has a reasonably long-term horizon, although it doesn't have to be excessively long, not over a decade necessarily, but someone who's prepared to see at least one economic cycle play through, who's reasonably tolerant of interdecile volatility. It's a fund that is going to have its own rhythm in terms of its performance outcomes, and that's because of the relatively large allocation to global listed real assets of infrastructure and property. We've decided, as I say, for reasons of international structural development, that those asset classes need more representation, but that means it has a distinctive rhythm. It's a fund that does not have too many bonds in it. It's a growth fund by definition, and the bonds that it does have tend to be less in the sovereign space and more in the corporate, supranational and agency space. So those have different performance characteristics too to what you typically see. But if the investor understands those specific characteristics that make this fund a style of its own, they'd be very well suited to it. As is common with most growth funds, the largest individual asset class is international equities. Our approach, though, is somewhat different. We have, rather than say a 50% allocation to international equities, which might be standard in a New Zealand growth fund, we have a 35% benchmark for international equities in the broader sense. But on top of that, we have 20% allocated to global listed real assets. So the strategic weights there are 10% to global infrastructure, 10% to global property. So that brings us up to a 55% broad global equity allocation, including listed real assets. Then on top of that, we have a 25% New Zealand equity allocation. We have the 15% to global bonds and a 5% benchmark cash allocation. Well, we have international investment partners for both global equities and global bonds, and in addition, global listed real assets. So some of our input will come across from those partners and their specialist teams, Morgan Stanley Investment Management and Cohen Steers on the listed real asset side. In our own internal investment committees, we discuss the current macro outlook, we discuss forces affecting the valuation and the pricing of the components of the fund. Because we have a dedicated New Zealand equity analyst team within SALT, we get strong input also on the domestic equity side of allocations. We review active positions against our strategic benchmark and against our medium-term objectives, and then occasionally we will reallocate between, but we don't trade frequently within this fund. I coordinate the multi-factor funds in SALT, so there is myself backed up by our chief economist. Then we have analysts who are dedicated to their asset classes. Here in Auckland, we have majority New Zealand and Australian equity analysts operating here. For the global assets, we are coordinating with our offshore investment partners, Morgan Stanley and Cohen Steers. More broadly, though, the investment committee that signs off the decisions of this fund are the chief strategists and portfolio managers within the SALT team. We look for parts of the global market that perhaps have been underinvested in recent years and decades. We look for active opportunities. We believe that the move to passive funds around the world has left areas underinvested. And because some of those areas don't have high market capitalizations, we see opportunities there. And we are willing to allocate more than a passive allocation would suggest, and in some cases, significantly more. We both maintain our own research channels and avail ourselves of the research channels that we get from our international investment partners. Well, in a multi-sector fund that invests in global and domestic assets, risk is multidimensional, and our main risk that we concern ourselves for is not reaching the objectives of the client. We've indicated that this fund will outperform the New Zealand inflation rate by 5% on average over a rolling 5-year period. So our objective is that the client has no risk of having real returns lesser than what we have promised. Within that, though, we have to manage risks inside the asset classes that are the components of the fund. That's a specialized discipline, and we both do it in-house and in collaboration with our external investment partners. Definitely the differential point is that exposure to listed real assets. That is a theme in this fund, so it's aligned with long-term structural trends in the world economy, particularly infrastructure, but also global listed real estate. There's also a strong sustainability dimension to this fund. The global shares and global bonds component are particularly benchmarked to superior ESG factor scores, and global equities has specific sectors excluded from it. So investors concerned with environmental and climate impact would also be interested in that fund from that part of their objective profile.